When the economy starts to shift, the difference between those who lose and those who lead isn't luck, it's preparation. I'm Gerry, Weston, founder of Praetorian Consulting, and this is the 2026 Recession Playbook. Now, this next downturn will feel different. It won't be defined by mass layoffs or a housing collapse. What's coming will be slower, quieter, and in some ways, harder to spot. It will show up in rising living costs, healthcare inflation, new tariffs, and the pressure building behind the 2026 commercial real estate maturity wall. So let's talk about how to stay ahead. The first signs always appear where people least expect them. Watch the used car market and long-term auto loans. Pay attention to credit cards and personal lending. In commercial real estate, refinancing is getting tougher. And even multifamily properties are being squeezed by higher taxes and insurance costs. These are the early cracks that tell you where risk begins to build. Next, look at where your exposure is concentrated. In a downturn, what looks like a small risk can spread fast. Subprime auto loans, small office properties, import-heavy small businesses. Each one can multiply the impact when the economy tightens. At Praetorian, we help lenders see those connections clearly with tools that turn blind spots into actionable insights. Losses are another part of the story, not dramatic, but persistent. We expect charge-offs in credit cards and auto loans to stay high through 2026, and commercial real estate values to settle 20 to 30% below their last appraisals. Our stress testing models help clients turn those forecasts into solid board-ready plans for capital and reserves. When you adjust your underwriting, do it with purpose. Shorten loan terms. Ask for stronger down payments. Revisit your DSCR test. Make sure insurance coverage is current and complete. And don't wait for delinquency to show up before you act. Get your early warning and collection systems aligned now. That's what we call disciplined curiosity, the mindset that turns caution into confidence. And when it comes to collections, timing is everything. Most lenders move too late, waiting until 90 days past due. The strongest performers act at 30. They know who can recover and which assets need to move. With the right framework, collections can protect profits instead of just reacting to losses. Every cycle tests resilience. The difference is how you prepare. The lenders who take early action don't just survive the downturn, they come out stronger. At Praetorian, we guard portfolios, guide strategy, and help lenders stay ahead of what's next.